Okay, good morning, everyone, and welcome to another edition of the Coffee Microcaps Morning Meeting evening. We are starting a little bit later than normal today, but we've got three good ASIC microcap companies to present here this morning. I'm just going to run through a couple of intro slides, and then we're going to get straight into it with our first presenter. So, for anybody who is joining us for the first time, my name is Mark Tubb and I'm the founder of Coffee Microcaps, and you're all very welcome. I'd also like to thank RAS Research as a Service, our official sponsor here for all our online events at Coffee Microcaps. If you are looking for some research on some smaller microcap companies, please do check out their website. They've got about 25 names under coverage there, and a lot you probably won't get from some of the sell side brokers. Also, as always, a warm welcome to our friends from ASIC if they're joining us this morning. For anybody who is joining us for the first time, the companies we tend to have on here, capped under 300 million, our definition of a microcap, in revenue, heading towards cash flow break even, or are indeed already profitable, as some of our names are here this morning. We tend to now have companies from the resources and biotech sectors, so what I like to call industrial microcaps. Structured this morning's webinar, we've got three companies on deck with us this morning. Each company is going to present for about 20 minutes and then we'll have 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. This makes it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us pretty much on all the socials. Twitter is our main one. YouTube, as I said, for the recording of this webinar. And indeed, we've done well over 100 of these events now. So there's a large back catalogue of A6 microcap presentations on there. LinkedIn, and I do a monthly newsletter, which you can get on the Substack platform. So joining us this morning, he's there waiting. We'll have Adam Cadwallader, CEO and MD of Motio. Leading off the batting first, then we will have Rahul Guha from Fiducian Group joining us at midday. And then finally, we're going to swing down to Melbourne and we'll have Stephen Lydeamore, CEO of Immuron, back with us to give us an update. So that's enough from me. Adam, I'm just going to quickly stop sharing my screen. And if you want to start sharing yours.
Sure.
I'll let you know once I can see it coming up. Yeah, I can see the cover slide now. Adam, you can take it away when you're ready.
Great. Thank you, Mark. Again, another warm welcome to our friends at ASIC. Look, the agenda this morning, pretty straightforward. As I always say, firstly, I'm going to tell you a little bit about Motio, then in an awkwardly placed number 2 spot, provide a brief timeline about the business so far, followed hopefully more smoothly into some numbers, and then get very passionate about our business and hopefully happily get some questions for the things I've forgotten to put into the presentation. So let me tell you about Motio. We've been growing incredibly well for a business that started in the middle of a pandemic, I guess, and certainly from a timeline perspective, which I will run through with you in a few moments. We've achieved a lot in a short amount of time. With no additional capital injected since September 2020. We've developed through really acquisitive and organic growth across sort of incredibly high margin environments, which have got enormous potential. And our business has used sort of what I would call a step through strategy. So we haven't splashed startup style of cash. We've grown, monetized, then grown and monetized again. And through this, we've built a really high quality, reliable and robust digital screen networks, which I'll talk about in a sec. But I think probably I'd never advocate for starting a media company in the middle of a pandemic, but we've built and grown through this period and it's really set us up for the next phase. So I feel really pleased with that. Again, our business is a digital place-based media company. We're part of the out-of-home sector or the out-of-home advertising sector of the Australian media marketplace. I guess unlike traditional billboards where you might drive by the ad, or say in a shopping centre or an airport where you might walk past an ad, we operate in locations that take advantage of long dwell times, like medical centres that you see on the screen now, cafes and CBDs, and key urban affluent areas, which we've developed significantly in the past 12 months. Indoor sports and leisure centres, so think indoor cricket, soccer, netball, basketball, swimming centres, and of course our favourite bars and pubs across Australia. So as I said, all of these networks use the natural long dwell time of these environments to communicate to audiences. And look, we own and operate these digital screen networks in these environments. So our revenue is generated by selling advertising on the display. So not dissimilar to how a hotel makes its money. Each network is like a hotel with a number of rooms to sell, and we've got plenty of rooms still to sell. It costs about $4,000 to place a display in a location, and we're currently generating around $7,000 per location in advertising dollars on a revenue per location basis. This makes up about 82% of our total revenue. The other 15% of our revenue, plus a little bit more, is our software and payments platform called Sports with a Z, crass but good, which helps indoor sporting centres and team-based amateur sporting organisations manage their competitions and payments instead of using spreadsheets and cash, which has transformed a lot of those clubs. We've owned this business for a few years now, and it continues to build really high quality SaaS revenue and earn through payment aggregation of amateur sports environments. I guess certainly we're driven by technology and connectivity, but sales-led ideas and being a sales culture is very much at the beating heart of the business. And I think Motio is becoming really well known for transforming these sort of places and spaces and into communication-rich digital place-based environments. And look, this is about using digital signage to change the customer experience by enabling medical centres, cafes, pubs, indoor sporting centres to access space on our displays for their own promotions. So when we enter an environment, the display should enable economic activity, not just for us, but everyone that's connected to it. So it's a big call, but we're certainly achieving that. Importantly, what we do as a business is help brands connect to people with purpose. So whether that purpose is waiting for a coffee or waiting for your GP, long dwell time environments is what we're about. So background check, as I've called it, but how did we get here? I think, we kicked off with what is now MotioPlay. We acquired a business called Adline Media. We sort of got rid of our previous business. We picked up the Ampol and medical media representation. They were digital screen networks in Ampol and in indoor medical centres, which I'll talk about in a second. We acquired the O Media Medical Centre Network because it was too small to remain in their business, which I had my hands on while I was there for about 19 years. And we completed our first and only capital raise in that first FY 2021 year. Medical media, which I just alluded to, was acquired in 2022 through a scrip deal. And we invested about $1 million in cash, upgrading the good parts and decommissioning the bad. We also won the rights to install displays in the largest medical centre network in Australia called IPN, which probably means nothing to anyone. It's part of the Sonic Healthcare organisation. And yes, FY22 was a big year. We also acquired our beloved sports software company, which has been, which we'd kind of been representing from a sales perspective previous to that. FY23, we took on vendor debt and acquired O Media's cafe and venue networks, which has been great. We launched a number of new products, including the first iteration of a menu and communication product for pubs and cafes to display and sort of promote their own menus and promotions. And this year, we've really continued our success financially, as well as having, one of the most stable, most reliable digital screen networks in Australia. Not an easy feat. I guess this is sort of my perfect segue to talk numbers, but just reflecting on those few years, FY21, we've grown revenue significantly each year, and we've developed this high quality, sustainable business model. FY24 performance was, we grew every quarter, and quarter four we posted what we thought was our best ever. And then Q1 this year, this FY25 year came along, and I guess over the short life of our business, the first quarter has been really traditionally softer. So in July, I actually reported to shareholders that we'd exceeded our budget for the first quarter in the first 19 days of this year, and we finished the quarter surpassing that of our best quarter ever. So quarter one FY25, now our best quarter to date. Our revenue per location in FY24 went past $6,000, and as I said before, we anticipate that we'll exceed, or have already exceeded really, $7,000 revenue per location for FY25. And look, if quarter one's anything to go by, and certainly quarter two is doing something similar, we'd be very confident with that, finishing up with that revenue per location forecast. We'll obviously continue to analyze each of our locations in all of those different channels, revenue performance, rationalizing where we need to, and moving into sort of more lucrative areas where we can provide advertisers valuable tactical outcomes. I guess a tactical example would be, placing a digital display in a medical center where, say, English may not be spoken as widely in a particular area, so we can offer content and important health messaging for, say, government that might pay a premium to do that communication in different languages, or maybe moving a cafe network, a cafe into a key urban hub or high socioeconomic area where it may be difficult to achieve sort of mainstream out-of-home development. Our FY24 results were above our guidance. We finished 27% up, and an EBITDA of $465,000. That also includes putting the rent in that money, because we don't publish rubbish numbers. The out-of-home industry actually was up 8%, so we're really proud of the result. We're also guiding 9.3 to 9.6 million revenue for FY25 and EBITDA in excess of 1 million, which pretty much will enable us to aggressively pay down the debt to iMedia this year. And whilst we grew 27% year on year on revenue, media was actually the star of the show, which was actually up 31.5% year on year. So I guess, why do we believe so much in our business? Look, we've got a really great team. We've got an experienced management team, strong, proven track record in outdoor and out-of-home and also media. We're always looking to expand into cash flow positive positions with scalable, repeatable opportunities. We're certainly set up for that. I think we're an incredibly innovative and creative business. We're creating economic activity wherever we're present, as I mentioned before. Unbelievably, we're currently valued at less than 1 times revenue. It's a crying shame, as I've said before. We've got such a great business and great people driving it. I know a number of small caps, sub 10 and 20 million, that are posting free cash flow are generally seeing a re-rate. Many have doubled and tripled or more in the last 6 months. But look, we've constantly increased revenue, operational efficiencies, cash flow, opportunities for the business. We're ready to expand at any given moment. Our team can take on more, and we are very much ready to scale further as a business. FY25 is going to be a great year for Motio. Audience measurement is on the way, and we're really optimistic about what that will do for our business and the industry. So in really, I guess, sort of fundamental terms, this will allow our networks to be measured alongside the likes of large format billboards, shopping centres and bus shelters, for example, as part of the entire industry. So when an advertising agency is looking to plan through the Move software, all of our networks will now appear and be measured. So it's, provide advertisers with further confidence in our network as we integrate into this system. So it's very exciting. It's for all of the place-based sector in Australia. So it's going to be brilliant. We're expecting that sort of probably towards the middle of next year. We've invested in making our audience feel more valued through great technology that helps our commercial property partners, as I mentioned before, with the menu boards. So we've got our displays to help them talk to their customers in ways that they never have before. And I guess while we're on that, I mentioned that our commercial partners are turning to us to help them solve their problems in their business through the digital screens as a communication channel. We've brought in AI to develop creative advertising outputs at speed and scale, as well as actually using sort of machine learning, across our pricing models to get the most out of every single display. Again, not dissimilar to how a hotel might optimize their business. We're really continuing to deploy incredible sales and marketing to clients, and the clients that see us as highly relevant, that really get our spaces, are investing more and more, which is really exciting. And I think, lastly, and somewhat connected to that, the maturity of our team and our business, as well as the technology, have also been incredibly friendly to us. So the advertising market trusts us to operate well, and these, I guess these qualities continue to drive really increased results. FY25 is already a year to remember for us. Consolidating and monetizing, the team is laser focused on top and bottom line results. Our network size is great. And while we're working diligently to sell more spaces on existing inventory, we're always looking for the best ways to grow the network that gives us immediate monetization possibilities. So it's not just a grow and hope. It's we can go into a certain area. We know how much it costs to go in there, and we know how much we can get out of that location. So we're taking really positive advantage of the maturation of our people, market relationships, as we continue to build the Motio brand. And as I said earlier, the guidance is 11 to 15% growth year on year. So we're targeting that 9.3 to 9.6 million in FY25. We seem to be on track for that, with a cash EBITDA to exceed 1 million this financial year. I am doing market updates every 10 weeks. So on the next one's on the 14th of November, which is our AGM. We don't do quarterly reporting. We don't have to, unlike most companies our size. But I do commit to these trading updates every 10 weeks. I absolutely love this business. It's been so rewarding to see it grow. We've had amazing shareholder support, amazing people to support me and the business. I'm really, really pleased with where we're at. So whilst this is probably a very short presentation for the day, I really just want to say thank you for joining and listening to this. It's a great opportunity, and thank you, Mark, for having me today. Happy to take questions, as I mentioned.
Thanks, Adam. Thanks again for joining us. Maybe I'll just kick off the first one in terms of the imminent. I was just thinking, you're talking about all these venues, the imminent switch off of 3G. It's been in the media a lot. Does that have any impact on you in terms of having to upgrade some of the stuff that you've taken over, or is it it's not really going to have a massive impact at all?
Where all of our stuff is on 4G and 5G, so we don't run any 3G. I think outdoor advertising kind of dispensed with that sort of 3 or 4 years ago, so it hasn't really been a big impact.
Okay, perfect. And then I know you talked about the seasonality of the business in Q1 being particularly a weak quarter, historically. Can you just maybe talk through what causes that? Is it just because we've come to the end of the financial year and a lot of marketing campaigns have kind of ran their budget, and it takes a while to kind of get into the following year's budgets?
Yeah, look, I think there's different parts to it, but for us, winter for our health business is traditionally very strong. So that sort of April, May, June period goes really well in our health business, and it's okay for everything else. I think this year everything went really well coming into the last quarter. We had a great last quarter, but then starting this quarter, which, as I said, traditionally soft, I don't think we had anticipated how well we would have gone. And even into quarter two, that whilst it hasn't been percentage-wise to budget as strong, it's certainly from a cash perspective doing as well.
Okay. And you're talking about, you're still looking to, I guess, expand venues and get more screens.
Yeah.
Does that look like acquiring something that has, access? It gives you access to, 500 more venues, if I can say that, or is it
If there
more
was
organically
something,
doing a deal that gets you into 30
yeah.
venues or 40 venues?
So organically, we're always looking. So we've got a small commercial team that are always looking to fill the pipeline. Just generally speaking, you might have a cafe or two that goes out of business, and so you have to replace those over time. They're pretty much baked into our business model. But we're always looking for that next place. We go, what, if we could get that, and we could generate more revenue. The medical center business is going really, really well. So we know where we're doing really well locally, so selling to local businesses, where programmatic is having an effect, which is machines buying, and then also where big brands are looking to invest. So it's really easy these days to go yes, no in a very simple matrix style to decide what we're going into. So yes, organic growth is always on our radar. Acquisitive growth, look, if we could find another business that looked like ours, that was cash flow positive, that kind of made sense economically, yeah, we would get into it. And those businesses are out there, but it's also about finding the right time. We would like to see our share price going a lot better, to support that thesis as well.
Yeah. We got two questions in from the audience here. One just on maybe first principles of unit economics. So the question is, 4K to build, 7K revenue. If we take this year's kind of numbers, how much of that is clear profit, and does it vary widely per screen, or is it relatively uniform?
Look, we look at it on a portfolio basis, right? So there are obviously some places that do incredibly well, and there are some places that maybe don't do as well. Where I can think of a medical centre on the northern beaches of Sydney. It's a very big one. It's got several screens in it. We're fully booked in that centre, and we'll probably do $25,000 in revenue on that location alone. I can also think of another very similar location in southern Sydney that traditionally goes very well with local advertising, but it hasn't gone well. So it's like what we call a dark area. So there's sometimes method in it, in the madness, but there's oftentimes when you just like it, that doesn't make any sense. But on a portfolio basis, that's how we look at it at any given moment, because it's the portfolio that gets national advertising dollars to come in. If we don't have 500 plus locations in medical centers, then national advertising is not particularly interested in advertising with us. However, looking at specific locations is where we really get the lift in revenue through local and programmatic sales.
Yeah. Another one here. This is on the sports business. What's the prospect of it to be used outside amateur sports, and does the revenue from the business remain level, or is it growing? That's kind of a two-part.
So the business started in the United Kingdom. So it was built by the guy who we bought it off, who still works in the business. He got frustrated with managing his local netball competition and built a piece of software. Now we've got probably 70,000 users across the world. We've just gone into the US. We're in New Zealand. We're in South Africa, and of course the UK and Australia. UK and Australia being the two largest markets. What we're finding is there are bigger organisations such as Touch Rugby League that use our software that's outside of that indoor sporting centre environment. So that's a really long way of saying, yes, there's a lot of application for club-based or amateur sporting environments that aren't in indoor sporting centres. The input sporting centres are great because we've got media in there. We integrate the sports software into the screen, so when you go into a sports centre, you can see what court you're playing on, who you're playing, where you are in the ladder. But that doesn't stop us working with organisations outside of that environment.
Okay, and
so it does have a huge total addressable market.
And does the other second half of that question, revenue from the business, if we talk FY24, was it up year over year?
Yeah, so it was up slightly. Obviously, SaaS revenue is a little harder to generate over time. It's got a lot longer sales cycle. But yes, it was just shy of 1.2 million in revenue for FY24.
Okay. Another question here. Yeah, I think we maybe kind of addressed this there, talking about, the 7K revenue per location. Is there a rough ceiling for revenue per location? But again, as you say, you kind of have to look at it on a portfolio basis because no two venues are the same, and an advertiser, local or national, could be happy to pay more in one venue versus another.
You're right, Mark. And a lot of times, investors will come to us and go, well, if you can get $7,000 a location, why don't you just put another 100 locations in? And it's not that simple. It kind of comes down to real estate like that. Is like, well, where is a piece of real estate going to work? So a medical centre, for example, in southwestern Sydney might work better for us from a local perspective than in the North Shore, as an example. Now, on a pure real estate play, that wouldn't make sense. But from a billboard, if you're a big billboard, you're going to get more money for a big billboard on the North Shore of Sydney versus southwestern Sydney, just on pure economics. But in our business, it's very different.
I actually wanted to put in one I wrote down on for the sports business. In terms of acquiring customers in that, is it, talking to, Netball New South Wales, for example, or is it, just kind of direct to the actual players, when they're in there, where like somebody's managing this league for, Northern Beaches netball, and they're like, oh, like there has to be an easier way to do this. Like, how, just maybe talk through the customer acquisition piece of that. I know Michael's not here. It's probably a better question for him, but
no, it's fine. I look, the perfect customer for us is a commercial-based large amateur sporting event. So, as I said, Touch Rugby League is a great example, where you've got an organisation that is running literally thousands of players in literally, so many different fields and different times and places, and our software will automate that. So, in answer to your question, the customer is the organisation or the organizer of the sport. So university sports has been a really big pathway for us this year. It's been fantastic. We're a place like Griffith University that use it for all of their sporting environments. And in the US, we tapped into a baseball competition in Texas. So there's some really, some bizarre sort of looks at what's happening, but it's a great piece of software. We've got a small team, so we're not, we're working sort of to our capacity, but certainly additional business development, we could continue to open up markets.
Okay. And then I just wanted to touch on with the cash flows that are coming through. You mentioned, paying down the media debt, from the original acquisitions. How are you thinking about, balancing that with, kind of investing in the business, and, just give us a sense of, where you'd like the debt profile to be at the end of the year.
Look, I'd really like to probably pay down at least $500,000 this year. That's my personal want. I just kind of eating into it as fast as we can is probably where I'm at. But also giving us plenty of buffer of cash to make sure that we're not out of pocket. We've got about $1.3 million in the bank at the moment. We're going really well. We're probably ahead of our cash flow position because of where we're at year to date. So I think we're feeling really safe in being able to do all of the things that we need to do, including grow organically. So yeah, we're probably feeling as good as we ever have. And I don't want to do the touch wood thing because I don't think that's great. I think that's crazy. But we're going really well. The business is sort of bucking trends, I guess. But as I've said to investors over time, the canary in the mine is not dead.
Yeah,
It's alive and well.
alive and well. We might just squeeze in maybe one or two more before Rahul joins us. I know when you were last with us at the Sydney conference back in March, you guys have a lot of access to data, and Move 2.0 is obviously coming, but
Yeah.
broader as an industry, you have an access to a lot of that data. What is that telling you about the economy and kind of the outlook for kind of Motio's customers in FY25? Because a lot of the economic data we get, suggests the job market seems robust, but you talk to any business and they're all saying they're like doing it tough. So you get like mixed messaging all the time. So maybe, what are you seeing from the data sets that you get?
I don't think there's anything that I'm getting that we haven't read in the press. It's there are sectors that are doing well. For example, our medical center group, one of the biggest users of medical centers is people over the age of 65. So we're getting huge demand from places like aged care, pharmaceutical, government that are wanting to speak to that sector. Those people tend to be slightly less on social media and online. So it's a great way of organically reaching those people en masse, or what I call a niche audience at scale. So there's plenty of bad news out there, but somehow, even our cafe environment is targeting people with like in small business or young people wanting to travel. There's a lot of people out there that have got, a lot of money to burn. It's just us poor mortgage holders that are probably, in the challenging area.
Yeah. Okay, Adam, I see Rahul has joined us here, so we'll leave it there. Thanks very much for joining us once again.
Great.
And yeah, we'll hopefully touch base early 2025.
Thank you very much for having me, Mark, and thanks everyone for joining.
Thanks, Adam.
Okay.
And I'll welcome Rahul Guha from Fiducian. Rahul, thank you very much for joining us this morning. If you want to start sharing your presentation, I'll let you know when I can see it coming through on screen here. Yeah, it's just loading now. Yeah, I can see the cover slide now, Rahul. You can take it away whenever you're ready.
Excellent. Thank you, Mark. Really appreciate you giving us the opportunity and present to your clients about the Fiducian story. My name is Rahul Guha. I'm the Executive Chairman of Fiducian Services, which is part of Fiducian Group. I've been with Fiducian roughly about 12 years, but Fiducian has been in operation for more than about 28 years now. So we have been listed in ASX also for a very long time. As an organization, we operate mainly in Australia. We have got roughly about 46 offices all across Australia, both salaried as well as franchisee offices. We have got about 200 staff, about 80 million revenue, and really three main lines of businesses, which I'm hoping to share with you guys today. The main lines of businesses being the platform administration, the funds management, and also the financial planning. So what I wanted to cover today is just give you a business overview, look at the financials, and also have some time for questions if there are any. So starting off with our first line of business, which is the platform administration. We have our own technology, and back in 2012, we launched our own platform, with our own technology, which is called Fast Track. We offer an IDPS product, which is investor-directed portfolio services, and also a superannuation product, which is the superannuation, and we have got our own licenses for both. We offer to all of our financial advisors, which is Fiducian advisors, but we also offer to IFAs also, which I'm going to talk about in next slide. But if I can please highlight that in last financial year, we had a net inflows of roughly about 281 million. And to give you the context, we are one of the few players in the industry. But if you look at some of the major players, and you can pick any names, whether it's BT, whether it's Colonial, whether it's IWF, every single big players in the platform industry over the last at least 5 years have had consistent outflows. So each quarter, each year, they report outflows from the platform. And we are in the very few minority which who have consistently produced positive net inflows during the period. As I mentioned, last financial year, we had about 280 million. In the first 3 months, we have clocked in roughly about 100 million in net inflows. And almost all of our net inflows really go into the Fiducian platform and also the Fiducian multi-manager funds, which we are going to talk about in a moment. Now, funds under administration, our balances last year was about 3.547 million. And today, as of end of September, our balance is roughly about 3.691 billion. And if I were to compare that with last year's average of 3.3 billion, we have seen roughly an increase of 10% in 2025 compared to our average in 2024. And if I were to extrapolate that into revenue terms, we should, if market holds, we should get roughly about $1 million extra in revenue through our platform side of the business. As I mentioned to you before, what we offer is what we believe is really the leading edge technology. I'll give you one of the example. One of our competitors, about maybe 2-3 months back or 3-4 months back, they made an announcement, quite a big announcement, and this is one of the big name, which is Insignia. And they said that they have rolled out one of the platform features where the client as well as the advisors, when they're selling their assets, they can choose the tax parcels. That is, they can choose whether it's a first in, first out, or whether they want to minimize or maximize profit or loss, they can do that. And we are sitting in there ourselves and we are thinking, that's great, that's a great feature. But that feature we had at least about 4 years in our platform. And similarly, a lot of people, maybe when the COVID is coming in, they came in with the features of multi-factor authentication. That is, when you go to the platform, it asks for a separate authentication. Again, a lot of the features that our competitors are rolling out, we are very proud to say that we already have that for a long time in our system. Now, the core platform, we have, as I mentioned before, we have got the investment as well as super. We offer the Fiducian funds. We have got roughly about 30 external funds and also the shares, term deposits, and so on and so forth. Now, having been successfully running the platform, as I touched upon before, the net inflows, this particular chart gives you a visual on how the net inflows have gone. And as you can see, over the last maybe 5 years, 5 years, 6 years, you can see we have had very consistent positive 6 monthly net inflows. And also over the period, again, similar kind of period, you can see our revenue has grown, our average funds under administration has grown, and as a result, the profit before tax margin has also grown, which stands to roughly about 64% of our gross revenue. Now, having operated quite successfully over the years, currently we are focusing on making our platform available to the external market. So although we have had a good success, that success has been built mainly catering to our internal advisors, which is Fiducian Financial Services. Now, what we feel is that if our platform is good enough and if it's working, if it's scalable, if it's got the right functionality, why can't we offer not only to the 80 financial advisors that we have, but to the entire Australian market of 10,000 advisors? So to that, we launched a product called Auxilium, and we have been marketing this quite heavily over the last 6 months to 1 year. And we have also launched out 4 badges to different dealer groups. We offer quite an extensive investment menu, all of the shares in ASX, international shares, roughly about 400 to 500 managed funds, term deposits, and so on and so forth. And in the last financial year, we have had about net inflows of 20 million. and also total funds under admin roughly sits at about 100 million. It's still about early days, but we have definitely seen positive indications from the market, and some of the early success stories is coming through. Our platform is it's one of the cheapest, if not the cheapest in the market. It starts at roughly about 20 basis points scaling down, and over about $1 million, you don't pay anything at all. The clients won't be paying anything at all. Now, this platform, as I said, it's really catered towards the external clients and external advisors, meaning that it has got all the right functionalities, all the features, all the services that we provide, but hasn't got the Fiducian funds, which is really the jewel in our crown. So yeah, you saw the net inflows that's coming through before from our own internal financial advisors, but the internal financial advisors has got access to Fiducian funds, which the Auxilium platform other badges don't. So although this is a cheap product, and as a result, we are not expecting any cannibalization coming through from our main core platform products. Moving on to the funds management business, we are really a multi-manager, which means that our investment managers, we have got an investment team as well as investment committee within Fiducian, but they don't select a stock. We don't select BHP, we don't to buy or Rio to sell. What we do is we select fund managers. We work with roughly about 45 to 50 different fund managers, both in Australia as well as overseas. So our investment team chooses through a very diligent and long-run process all the fund managers. Some of them will be chosen for their growth style, some of them for value style. And what we do internally is just depending on the outlook of the economy as well as the cycle, we mix different styles. So we do the tactical allocation, we do the manager allocations, and our target is not really to shoot the lights out. We don't want to be the number one. All we want to do is to make sure that we are able to generate a little bit more returns compared to the average by taking a little bit less risk compared to the average risk in the industry. And when we do it year in, year out, we end up in the top quartile. I'll just quickly move to the next slide, which sort of gives the indication of where our performance is happening. And we offer roughly about 15 Fiducian funds, and 5 of them are diversified funds. And diversified funds, which invest in, as an example, balance, growth, ultra growth, capital stable, invest in our core funds, which are the Australian share fund, international share funds, fixed interest funds, and so on and so forth. Now, if you were to look, balance fund as an example, 1 year returns, 17.5, 67 out of 168. 3-year returns, 133, 5-year returns, 46, 7-year, 25, 10-year returns, very much in the top decile. And the same history and same message goes across the periods. Now, as the COVID hit back in 2020, for the next 2 years, our performance was a little bit subdued. And the main reason was because we invest 100% of our stocks all listed. So we don't have alternatives, we don't have funny hedges and so on and so forth. So everything gets valued on a daily basis. But because of that, we also took a hit in the last 3 to 5 year performance. But what we are hoping is that as we progress, the investment philosophy that we get will bring us back to track on focusing on the process for our clients. Just going back to the previous slide quickly, currently, as of end of it's meant to read end of September, my apologies. The end of September, we have got roughly about 5.5 billion in funds under management. And comparing that with last year's average of 4.8 billion, we are seeing roughly about 13% increase in our current level of funds compared to the average that we had last year. And again, extrapolating that to our margins that we earn, that could see us potentially earning about 2.8 million on an annualized basis in the current financial year. In terms of the what's the benefits? Why does someone wants to come to Fiducian if they can go directly to BT or Ausbil or one of the fund managers do we have? Now let's take the example of BT. If one of you or one of your clients want to invest on BT Australian Share Fund, they will pay a fee. And that fee will be, I'll take the example of balance fund. That fee will be roughly about 100 basis points. That's the industry average, 97 basis points. Now, through us, when they invest, they will pay the same level of fees, what they pay to BT. Our balance fund fees is about 93 basis points. So in terms of fees, they are no worse off by investing through Fiducian rather than the fund managers directly. Now, if one of your clients or yourself have got $10,000, now you can invest that in BT. But when you invest through Fiducian, that $10,000 get invested roughly to about 27 different fund managers. So your single investments, you didn't only need to deal with Fiducian, not the 27 individual fund managers. Your single investments will be totally diversified and managed by 27 very able managers through our fund. So in terms of fees, you're more or less same compared to the industry. In terms of diversification, you're able to achieve, or a client is able to achieve, a full diversification through Fiducian. And additionally, they also get the overlay of what our investment managers does is the tactical allocation. So instead of the client or the advisors continuously having to monitor their platform, and as you know, as an advisor, they always need to pick the right fund manager. Now, unfortunately, it's extremely difficult to pick the right fund manager. Who's the right fund manager? Someone who's been the best in their performances this financial year. So yes, you can put the client's money into that fund manager who's the best this financial year, but what guarantee do you have that they'll still perform and won't end up the worst fund manager next year? But through the diversification process that Fiducian offers, we are able to cross that bridge and able to give the diversification, and also, as I showed before, the consistent returns across the long term. So that's really a funds management business, and our gross profit and our profit margins on the gross revenue is roughly about 50 basis points. So we are making a decent margins through this model. The client is happy because they are paying the same fee, as well as the diversification they are able to achieve. Advisor is happy because they can give what the client wants, and the shareholders and Fiducian also make sense because we are able to make a margin through this model. Now, both of this platform, as well as funds management and also financial planning, is brought together by our own fintech capabilities. And I took a few examples on our platform. We have got our own platform software, but we also have got our fourth software, which is the financial planning software, which is the equivalent of Xplan, but much more efficient system and hasn't got the clunkiness that Xplan has. And finally, we have got our own Fiducian Online also, which is the holistic client reporting system. Now, all of these businesses are really brought together by a financial planning business, which we believe is the enabler of bringing funds into our platform, and also the funds management segments of the business. Last financial year, we opened about 3 new offices. We have got offices all across Australia in every state, and we have got roughly about 48 offices and 80 financial advisors, about half of them salaried and half of them are franchisees. We have set an inflow targets for all of our advisors of roughly about $6 million in the current financial year. And also we have raised the revenue targets for our advisors from between 10 to 20% in the current financial year. Now, interestingly, when I look at across the industry, the average fees that a financial advisor charges in Australia is roughly about $4,600. The average fees that a Fiducian financial planner charges is roughly about $2,700. So we are far below the market, and one would say that we are probably maybe undercutting ourselves. And when our financial advisors have gone back to the clients and they said that there will be an increase in fees, and we have got almost zero resistance or zero complaints about any fee increases. So our advisors are being able to generate those fee increases as we talk through as well. We currently have roughly about 4.8 billion as of end of June. That has gone slightly up as of end of September. And out of this 4.8 billion, about 1.6 billion is sitting in external platform. So what does that mean? So when our clients invest in external platform, and there's always a reason why the money may stay in an external platform. And that reason could be Centrelink issues. If they move the money across from external into Fiducian platform, they may lose the Centrelink benefits, or there may be capital gains issues or some other issues. Maybe they have got annuities and so on and so forth. But there's always a chance that if it's best for the client and if it's right for the client, our advisors may make the recommendation that this money, or at least a part of this 1.6 billion that's sitting across outside, may move across to Fiducian platform and Fiducian funds if it's right for the clients. And if that happens, we can look at as a margin expansion, roughly about 100 basis points combined from the platform as well as the funds. Now, I must point out that some of these funds are also non-fee paying, are based on the non-fee paying clients. That is, those are legacy clients. As of now, we are not getting any revenue from them. We are not providing any service to them. But there's an opportunity that if it's right for the client and for the advisors, we may be able to re-engage them and make them a revenue paying client. And if we are not able to re-engage them, we will disengage them, so they won't be in our numbers. So potentially these external platform numbers could fall slightly, but we don't expect any revenue impacts from them. I touched upon staffing earlier. So roughly we have got about 173 FTE, or close to about 200 headcount, and the numbers haven't really gone up or gone down significantly. We have got a very stable staff base in our company. As I mentioned, I've been with the organization about 12 years, and I still get reminded every now and then I'm the newest person in the exec team. So even after spending 12 years, if I've got to still be reminded that I've been only there since yesterday, I'm sure the company is doing something right. So staff is definitely one of our, if not the most valuable assets that we have. And we look after our staff, including salary increases, and make sure that they have got a stable and happy journey through Fiducian. Now, looking at the financials, last week we had our AGM and we announced the quarterly. We gave a voluntary disclosure to the market on ASX 4C, which is the cash flow. We don't need to, but because we don't give out any forecast on a non-reporting periods, non-reporting quarters, which is September and March, we produce this quarterly cash flows. Now, as part of the announcement, we said that, as I touched upon earlier, we have had about 100 million in net inflows in the first quarter, and this has definitely been the highest net inflows, definitely in the last 5 years, possibly in the last 10 years in the first quarter. And as a comparison, it's about 60 million we had in the comparable period in September 2023. Our badge platform balance stands at about 102 million. And the IFA for the quarter, we also had revenue had inflows coming in, and some of the legacy IFAs also left about 13 million. Our funds under management in total is about 14.2 billion. Our operating cash flow is about 4.5 million, my apologies. But factoring in the timing of the expenses and the actual cash payments, we are looking at roughly about 500K more if that timing were not there. So that's sort of a proxy of operating profit for the quarter. Financial highlights, I won't go through each line items, but as you can see, all the matrices are showing the right direction. We had an underlying net profit increase of roughly about 17%, stat net profit increase last year about 22%, and all of our business segments have been producing positive contributions to the group. A quick slide on outperformance, and this slide goes back from June 2012 till June 2024. And I really should have updated this slide, my apologies, but when it was last done, 7.45, our share price is sitting slightly more than that, close to $9, $8.50 to $9. But even on $7.45 basis, you can see a huge outperformance compared to how all odds, including the dividends, have performed. In fact, some of our clients, some of our investors, shareholders are long-term investors in Fiducian. And if someone had invested $1,000 about back in July 2012, they would have been getting a 41% dividend yield in the current financial year. In fact, we have been listed about 24 years, and out of those 24 years, 18 of those we have been able to produce double-digit earnings growth. Our FUMA, as you can see, has grown steadily. And if I go to my last slide, which is not a projection, but more of a conceptual representation. And so I'll take maybe a couple of minutes to go through this slide, and I try to explain this slide, what it's trying to portray. So in this axis, what we have got is the different time periods. In 2013, our FUMA was roughly about 3 billion. In last financial year, as I said before, our FUMA was 12.9 billion, so currently sitting about roughly 14.2 billion. Now, over the time, our expenses, which is the red line, 2013, our level of expenses was roughly about maybe a little bit, maybe 12 million, 13 million, something like that. So that has definitely grown compared to what it was in 2013. Now, our revenue line, which is the green line, that has also gone over the period. And as you can see, the growth rate of the revenue line is far faster compared to the red line. So as a result, the jaws of growth, the difference between the red line and the green line has pretty much increased as we have been able to grow our FUMA base. So what we expect that it's as I can reiterate, it's a conceptual representation. What we feel is that as the FUMA grows, there's a potential for this yaw of growth and the resultant EBITDA also to grow as we get the benefits from the scalability of the business. So those were the main things I wanted to share and take you through, guys. And again, thank you so much for your time, and happy to take any questions, Mark.
Thanks, Rahul. Yeah, we've got one here in already. Given the shortage of financial advisors and the increasing demand for advice, are you seeing, revenue per advisor increase significantly? I know you talked about putting up price, but I think this is more geared to just like the volume of requests that's coming across financial planners' desks for statements of advice, and what that can do to kind of margins as well.
Yeah, no, I think that's an excellent question, Mark, and thank you for putting that up from the audience. Let me start with an example, and let me give the context also of the challenges that we have. So as I mentioned, so the average advice fee is $4,600, and people are saying that the advisors are saying is that's not enough. The clients are saying, no, we don't want to pay too much. It's too expensive. We can't afford that. And if someone's on a 50K super balance, on a maybe 60K salary, paying a $4,600 is quite hard as well. Now, one of the segment that what we are finding, Mark and the team, is that there's a huge market in Australia where the clients are very much underserviced. And the traditional players, all the big name players who wants to focus on wealthy clients, even us, Mark, as an example, our client size is roughly averaging for super roughly about 350K, 400K, or investments a little bit over $500,000. But you've got high net worth, you've got ultra high net worth, they are being serviced very well. But the other segment with the 50K, 100K, there's a dearth of advisors. Now, the example I wanted to take was we partnered with one of the advice group, and they were more on a telephone-based advice, and they were focusing on that market. And when we partnered with them, we were getting roughly about $5 million each week. Now, as I said before, we had 80 advisors, and last year we had 280 million in the whole year. And this small advice group was able to generate about $5 million every month in the new businesses. So I think there's a very strong. Unfortunately, we had to put a stop on that because of some negative coverage in the media, as well as with ASIC on the advice group. But we have worked with them very closely and strengthened their compliance and governance process. And we're hoping that we can restart that process. But that also maybe gives us the opportunity, if we start thinking in a different way and recognize there's a different breadth of clients and a lot of them are underserviced, I think there's a huge market potentially that we could tap on, Mark.
Maybe a follow-on question from me in relation to that. We've had SEQ on here. We've had a couple of other, competitors of yours on the financial planning side now to speak of. And I mean,
Yeah.
it's universal. There's a dearth of financial planners, and a lot of financial planners have retired out of the industry in recent years, and it hasn't been a career that's been chosen by a lot of young finance professionals. So in terms of trying to grow the financial planner base, I mean, what are you doing to, attract new planners, replace, planners who are retiring and, want to sell their book to somebody? Maybe just talk about, to grow the business, how you're attracting the limited talent that's out there into Fiducian.
Yeah, no, absolutely. I think that's a very good question as well, Mark. I know I'm happy to stay for the rest of the day, but I don't think Mark, yourself, your other clients have that much time. So if I can just maybe limit my answer to two specific examples. I think what's important for us is just making sure that we find the right financial advisor. And the definition of right financial advisors differ from the organization to organization. So our philosophy is right financial advisor gives a holistic advice to the clients. He or she is not a stock selector. He or she is not a fund manager that some of you guys are, and they have got their clients' interests in their heart. Now, the two examples I wanted to take quickly is one is Bendigo. We partnered with this financial advisor who was with someone else before, and it's a great guy, excellent guy, young guy, very much client focused. He wants to grow his business, but he just did not have the financial capacity. Now, what we did was we funded him roughly about $1 million to buy into some existing book of business. He's been able to grow that business quite a lot. And also when it's, again, right for the clients, he's been able to transition that money across from external platforms to Fiducian. So from that $1 million investment, the revenue that he's generating for us today is roughly about 350K on an annualized basis. So we make a $1 million investment, client is happy, they're getting the right advice, advisor is happy, he's able to grow the business. And from a company's perspective, also, we have been able to generate revenue synergies. Just the last example quickly is another guy, he's off Sunshine Coast. And again, great guy, knows all the right things, says all the right thing. Similarly, he did not have any client. He did not have any client base. He's all gung-ho, but how do we get clients for him? So what we did was we set up, you see all the HR block and other stalls in shopping centers. We funded him. So 1 month, we only spent about $5,000, Mark, nothing, $5,000. And he got about 16 clients from that 1 month exercise that he had, 1 month campaign promotion that he had. And he was able to convert those clients and grow his business, but also help us growing our business by getting the revenue synergies. So as you rightly said, getting the right financial advisor is very important. And our numbers are 80. Our target to grow this financial year is roughly about by 15 to 20. I'm not saying we'll get there, but there's a target. But that gives you the context that it's unlikely that Fiducian tomorrow we'll have 300 advisors and the next year we'll have 1,000. We want to grow more in a sustainable way, which we believe is the right for the business model that we have. Mark.
Okay, Rahul. Yeah, two interesting examples. I think, definitely in this market, you've got to be selective and align it to the various, kind of businesses and revenue synergies that, because a lot of these planner groups also have, different strategies and what they're trying to look to do. So thank you very much for joining us, and we'll switch now from Sydney down to Melbourne, as I know Stephen Lydeamore from Immuron is waiting very patiently for us there. Stephen, welcome back.
Yes, thank you. So I share my screen, Mark?
Yeah, if you could share it, Stephen, I'll let you know when I can see it coming through.
Okay, can you see that now?
Yeah, and if you just want to go into slideshow mode, Stephen, just so we get the full effect of it.
How's that?
That's perfect. Stephen, you can take it away whenever you're ready.
Okay, very good. Well, welcome everybody. I've presented to Coffee Microcaps a few times before, and very happy to be doing that again today. As you can see, we're listed on the Australian Stock Exchange under the ticker IMC, as well as on NASDAQ under IMRN. Just quickly, a safe harbour statement here. Our Financial year to date 2025 numbers have not been audited and are subject to audit review. We'll just provide you a quick update on who we are as a company. This is a snapshot on one page, really. So we're a small Melbourne-based biopharmaceutical company developing oral immunotherapeutics for treatment of gut-mediated diseases, and specifically we're targeting pathogens. In the case of one product, that's Travalan, IMM124E, for prevention of traveller's diarrhea, and we have IMM529 for prevention, treatment, and stopping recurrence of Clostridioides difficile, also known as C. diff or CDI. Our market cap is a little bit depressed at the moment. We had a readout on a CAMP-ETech phase 2 clinical trial that was being run by the Naval Medical Research Command with their experimental vaccine. Our role in that was to produce a hyperimmune bovine colostrum for them to test in this trial. And whilst it worked somewhat, not to the extent that they would have liked or we would have liked, hence the reaction on the share market, which is a bit unfortunate given that none of the analyst reports include any valuation for CAMP-ETech. So anyway, that's what happened, the share price down. We're working hard to get that back up again on the growth drivers that we have, which is Travalan that we sell as a commercial product, and I'll touch on the revenue in a minute. But we had just completed the first quarter for the financial year, $1.5 million. So that's the annual run rate of about $6 million, and that's up 13% on the prior quarter. And that $6 million run rate compares to 4.9 million that we completed 30th of June 2024 year. You'll see in the graph coming up that there's strong growth from all the countries that we sell in. That's Australia, in Canada, and in the US market. We have another phase 2 that did read out on March 7th. We had a positive market reaction to them. That's Travalan IMM124E in a phase 2 controlled human infection model study. For those that aren't familiar, this is where healthy volunteers, and there were 60 subjects, volunteered to get infected with enterotoxigenic E. coli to show whether our product did in fact prevent traveller's diarrhea caused by ETech, and we're pleased to say that it did. We have a second clinical trial with the same product being run by the Uniformed Services University, a much larger study. This is in US and UK active US military personnel travelling to high-risk regions to see whether, in the real-world setting, does Travalan prevent traveller's diarrhea. And as of the data reporting, we're 85% recruited, and we're targeting to have, I should say, Uniformed Services University is targeting to have 100% recruitment by the end of this calendar year. The Navy and the Army, that's NMRC and the Walter Reed Army Institute of Research, recently received a US $2.3 million award from the US Department of Defense to continue developing new formulations which will enhance Travalan in the future. This is a new slide, and I thought it was relevant just from feedback that I've got from previous conferences where people didn't really understand where Travalan fit. And so there is $1 billion market for traveller's diarrhea treatment, and at the moment, largely that's people taking products like Imodium or GastroStop or generic loperamide, rehydration salts and the like, after you get traveller's diarrhea. So we have a big opportunity in this $1 billion market to convert patients from taking products that they use for relief after you get it to a product like Travalan, which prevents it. And just to be clear, there is no FDA approved medicine for prevention of traveller's diarrhea, so we could be the very first. I've heard people ask questions about whether there's a white label threat. You know, this is for consumer products, the equivalent of a generic coming in there. And whilst our product is colostrum-based, it's not a generic colostrum. It has, we make it with a proprietary vaccine. It's 2 vaccines covering 13 different strains of enterotoxigenic E. coli. And we vaccinate dairy cows with that, and they produce antibodies which are specific for targeted pathogens, namely ETech. They fortunately also have some cross-reactivity for other pathogens as well, and we've shown that we have cross-reactivity in up to 180 different pathogens which are known to cause gut-mediated diseases. So how does it do that? It binds and neutralises to prevent. So that's the key message here. The key point of difference of our product is proprietary vaccine, binds, neutralises, prevents. So not a generic medicine, and big opportunity to convert people from a relief market to a prevention market for travellers' diarrhoea. Let's see how we're doing in that market. So I just mentioned we did the global $1.5 million for the quarter, up 13% on the prior quarter. 1 million of that came from Australia, and that was up some 3% on the prior quarter. But it doesn't yet show the effect of securing core ranging in another 9 pharmacy banner groups. So our largest customer is Chemist Warehouse. We have core ranging. They've in fact in some stores put us into dual listings in both the travel section and the gastrointestinal section within their store. And in other large pharmacy banners like Cadwallader, Chemmart, for example, we now have core ranging and Priceline and the like. And so we'll see in the next quarter continued growth from that. Likewise, in North America, we've just secured distribution in Canada in 10 pharmacy grocery retailers, and we had our strongest month ever in September on Amazon.com. So I'm really looking forward to that graph. You can see it continue to grow there, and it's nice to see Canada on top there, which is coloured in red. You know, I lived there for some 9 years, so I'm quite partial to that market. It's very, very similar to Australia. So it's a retail pharmacy market. You market a product very much like we do in Australia. Its population is somewhat larger than Australia. So over time, you should expect to see that red grow to equaling or exceeding the Australian part of the chart there. And the US market, we've just starting to get into a strong gear on the Amazon.com platform, where you're relying on their algorithms to kick you into trading. So we're seeing an uptick in that in September, and hoping to see another big uptick in the next quarter. Just on our clinical programs, I touched on most of these, but there's some upcoming milestones for each of them. So for IMM124E, when we get the final clinical study report from that phase 2 that I just mentioned, we submit that to the FDA and request an end of phase 2 meeting, and then we'll likely have a second follow-up meeting to discuss a phase 3 protocol. So we're looking forward in the next calendar year, in the second half, to moving in from phase 2 into phase 3, which is quite exciting for us. And that uniform university study, I mentioned that we're looking at completing recruitment by the end of the calendar year. We're looking at getting top-line data from that study showing whether it worked in April of next year. So both of those are quite highly valuable upcoming clinical milestones. This is the latest bit of news on our IMM529 asset. So this is one for Clostridioides difficile, C. diff or CDI. We had a pre-IND submission that we submitted to the FDA and had positive feedback from them. And what's changed here is that previously, when I presented a forecast for the product, it was some $90 million for it. And I've just got an updated revenue estimate here for $400 million for IMM529. So I've put it actually in the wrong side of the column here, so I'll correct that slide when I post it on our website. But that 400 million is for IMM529. The $93 million there was the old estimate. So big uptick, and that's because in that protocol that we're discussing with the FDA, we're talking about moving it from treating second recurrent Clostridioides difficile infections to using it as an adjuvant together with a standard of care, which is an antibiotic. And for those that are familiar with C. diff, C. diff is ironically both treated with and caused by antibiotics. And our product is not an antibiotic. It's not subject to antimicrobial resistance. And it's an oral product. There's a lot of good things going for it that physicians are very interested in using it for. And it also has a world's triple mechanism of action. So we know that toxin B is the primary toxin causing C. difficile, but it's an interesting pathogen in that it's a spore-forming pathogen, and it also has vegetative cells. And we use multiple vaccines to target not only toxin B, but also spores and vegetative cells, hence the triple mechanism of action. And you can see down the bottom there in terms of efficacy, and this is in the animal studies, we're showing statistically significant and clinically relevant prevention, protection, and treatment of primary disease. So very, very good results, and it gives us great confidence going into that phase 2 study. And back to Travelan, this is IMM124E moving into phase 3. This is just a summary of the results, showing 36.4 protective efficacy, 43.8%, even higher reduction in diarrhea of any severity, and that was approaching statistical significance. And what was statistically significant was the significant reduction in adverse events. And we also had good secondary endpoint results, which was quite impressive to the Navy and the Army that we're collaborating with. And we're in discussion with the US Department of Defense about continuing funding. They've been funding through grant money from preclinical all the way to phase 2. And we'll be seeking their support and assistance in moving from phase 2 into phase 3. And this is the timeline to that. So that clinical study report, end of this month, we're expecting that. We'll have those FDA meetings, the end of phase 2 and the phase 3 clinical protocol discussion. We're hoping to be able to start in the second half of next calendar year, the phase 3 studies. They'll run for approximately 2 years each. And after that is about 1 year for FDA review and approval. So that's the timeline for moving that asset into phase 3. And some people ask if IMM124E is Travelan and you're selling it on the market, why are we doing this? Firstly, the Department of Defense would like it to be a prescription medicine, but so would we. We would like that because at the moment in the US we can't make label claims. So whereas in Australia and Canada we can make claims for prevention and relief of travellers' diarrhoea. In the US, we're marketing it as a dietary supplement without claims, and that locks us into less than half of the market of those people just seeking self-treatment and buying our product on Amazon or through Walmart.com or perhaps through Passport Health travel clinics. What we're being locked out of is all those people that go to their physician, so whether it's their doctor or somebody to get prescriptions or injections or vaccinations for things that they want to prevent while they're travelling. And people do that all the time. So for those that are travel, you would know that hepatitis A, hepatitis B, and some exotic countries, typhoid and yellow fever. We would like to be the first FDA-approved medicine for prevention of travellers' diarrhoea. We would get onto the CDC Yellow Book guidelines. It would be read by all physicians worldwide, and hopefully, just while they're prescribing vaccines for hepatitis A and B, for those people travelling to countries where travellers' diarrhoea is of high risk, they would also prescribe Travelan. And even before that, the CDC Yellow Book could potentially look at the results from that Uniformed Services University study that reads out in April of next calendar year. And that in of itself may be enough to get into those guidelines. So we'll be working hard towards making that happen as well. So just summarising on the upcoming milestones here. So on revenue, the next quarter, we expect continued quarter-on-quarter growth from the growth drivers, and they're namely that core ranging that we now have in 9 pharmacy banner groups in Australia, continued strong growth on Amazon.com after our record month in September, and growth from the distribution that was sourced in 10 pharmacy grocery retailers in Canada. And here's a rich list of clinical milestones. So just quickly for each of the project names, IMM124E is Travelan, indication travellers' diarrhoea prevention. IMM529, Clostridioides difficile infection, also known as C. diff or CDI. And for each of these, we have a number of clinical milestones coming up. So first one for IMM124E, completing a recruitment for the phase, I'm calling it 2, but it's actually a phase 4 study here of 866 subjects. That top-line data from that same study reading out in April of next year. In the first half of next year, we've got those 2 FDA meetings for IMM124E, and in that same first half period, IMM529 for C. diff. We're going to submit an IND, that's investigative new drug submission to the FDA, which will allow us then to plan commencement of a phase 2 study. And in the second half of 2025. I'm not sure I've written initiate phase 3 here. That's because we'll be doing that for IMM124E, but IMM124E and IMM529 in the second half of next calendar year, we'll be looking at initiating trials, phase 2 for 529 and phase 3 for 124E. I might just skip through the references. They're there for you to read at your leisure if you're scientifically minded, but might pause there, Mark, for any questions that people may have.
Take myself off mute here and video. Yeah, we've got one here, Steve. Just on the advertising, this is in Australia, you know, somebody's saying, you know, you don't really see Travelan advertised in the airports, and they're saying, you know, if you take Melbourne Airport in the next like 6 months, you've got Melbourne Cup, Australian Open, F1, Ashes will be there for the Boxing Day test. You know, and they're saying, you know, not to mention fans, but like athletes traveling through there. Maybe just talk about you know, is it too late when people are at the airport? You know, is this kind of a thing you got to buy before you kind of get on the plane, and it's more when people are planning their trip that you got to advertise them to them at that point?
Ideally, we get them before they get to the airport. So, yeah, if you have a look at the Australian government's travel statistics, and the great news is if they break it down by country, and even though we're slightly behind the total number of travel numbers, short-term residents returning prior to COVID beginning, when you look at the countries that matter to us, so these are Bali, Vietnam, Thailand, all of them are significantly above what they were from pre-pandemic. And so we're really targeting customers traveling to those specific regions. And a lot of them, for example, travel on Jetstar. And so for those of you who've actually bought a ticket on Jetstar, you'll get your e-ticket, and they give us the opportunity to advertise Travelan on that e-ticket. So you get your e-ticket, and first thing you see is buy Travelan, which makes a lot of sense. And we're targeting people traveling to those countries. So ideally, we're going to get them before they go to the airport. Likewise, in pharmacies, there's really strong promotion within the pharmacy stores, both by the pharmacists and pharmacy assistants, especially in Chemist Warehouse, making people aware. If they're making inquiries about, I'm traveling here, what do you recommend that I take? If you go into Chemist Warehouse, I would hazard a guess that the first thing they recommend is Travelan, and they'll be buying it there. And it is less expensive to buy from you know, a high street pharmacy than it is from the airport. But every airport in Australia does stock Travelan. So if you didn't get it before you left, it is available, and they are very familiar with what it's used for, and they have it on the counter or in a very visible area for people. But it's true, we haven't yet taken the decision to advertise within the airports on TV or billboard type advertising, but it is something that we are considering.
Yeah. I know when you were last with Steve, you were talking about if we talk about the sales where Travelan is happening now, obviously Australia, Canada is starting to pick up a bit of steam, and the US, but you were talking about a potential, you know, UK market entry. I know you didn't mention it in your slides there, but maybe just give us a quick update on where that process is up to.
Yeah, so we have investigated the European market as a whole and settled on the UK market as being the most straightforward to enter for us, because it's an English-speaking country, and all of our marketing materials and labels and things can be used. And so from a marketing point of view, we're ready. From a regulatory point of view, we're ready. There is no registration requirement for what they call a food supplement in Europe, so we could go straight into the market. But you do have to have some preconditions, so we would need to enter into a contract with a suitable distributor that's got all the pharmaceutical warehouses and temperature conditions and storage and like, set up accounts with you know, Amazon and other retail chains and things like that. And we will do that. We're just working on making sure that we've got everything up and running in the US and Canada first. And we've also got our supply chain lined up, because there's a big lead time to build up the inventory required to launch in a new market. You only get one chance to launch well in a market. We want to launch well, and so when we're ready to do that, we will. And there's a good chance that may happen next calendar year.
Next calendar year. Okay, cool. And then I just wanted to talk about the Canadian market, if we can go back there, as it was a pretty decent market for you before COVID, and this is before you joined the business now, and a lot of the ranging and listing kind of got lost, and you're in the process of completely kind of building back what was there. But I don't know if you know it off the top of your head, but what was the kind of historical revenue that used to come out of the Canadian market for the travel and products, just to give people a sense of, we're here now, but in prior times, this is what the Canadian market, or even the US, so you can call it North America if you want, used to actually deliver for us.
Yeah, so that is a good question. I do happen to know that. So it was very unfortunate because we only really got to the point, Canada was marketed by a third-party distributor, and it was taken back by Immuron, and they launched themselves directly in the market. And the build-up to that peak sales happened just prior to COVID hitting, and so they hit peak sales of around $500,000 per annum. And we'll be targeting to try and exceed that record last year. The peak for the US market prior to COVID was around $1 million. And last financial year, we actually exceeded that. So we're planning to exceed the record that we exceeded last year for the US, and trying to create a new record for Canada. And we're already on track to create yet another new record for the Australian market as well. So, just to put it in perspective, last year we did 4.9 million. The year prior to that, we did 1.8. Year prior to that, we did 765,000. So we've got a pretty strong trajectory of growth, and we're working really hard to make sure that growth rate continues. It can't all come out of Australia like it has mostly to date, but that's why when you look at that graph, and I thought it would be interesting to show quarter-on-quarter growth, that US and Canada are now 1/3 of our revenue in that quarter, whereas previously they were less than that. So I would expect over time that those the blue and the red part of the chart there will continue to grow at a stronger rate than Australia. But Australia will continue to grow for the reasons that I've outlined previously.
And you were talking about, a lot of your trials are, funded by, let's put a unit, say Department of Defense or whatever, through their grants or whatever. But for some reason, let's say they decided that they're not going to fund any of it, or a particular stream or whatever. Given the cash balance that Immuron has, would you be happy to kind of pick it up and cover the cost of the phase 3 trial, or wherever it's up to in the could be phase 2B or something like that? Would is that an option if grant money dries up for budgetary concerns? Obviously, we've got the election now in a couple of weeks, and there's going to be potential change of president, of whether it's still going to be Democrats or changing over to Republicans. That always throws all these programs into a state of flux until there's a clear line of sight on what the new policy is going to be.
Yeah, that is a very good question. So we have had cash of 11 million as of June, and that in of itself is not enough to run clinical trials until their conclusion, because they run over two plus year periods for IMM 529 and 124E, as well as operating our entity. So we're working really hard to grow our sales, because that can become part of our funding mechanism. And I think I've mentioned before that somewhere between $10 and $15 million in revenue would cover everything other than R&D, and so we're working hard towards that. That won't happen this financial year, but potentially next financial year, if we can continue to grow at the strong clip that we've been going at. For the clinical trials, I'd like to think that we would fund them, but really that decision won't be taken until we get closer to that point, and probably not until after the USU clinical trial results for that IMM 124E phase 4 study, which comes out in April. If we can get the benefit of getting under the CDC Yellow Book from that study, then that Doesn't mean that we're not going to go ahead with phase 3 and try to get Travelan approved as a medicine, but it makes it less urgent. We would try and leverage that to get the military to start using it even before FDA approval as well, for example.
Okay. And as somebody who's got a CDC yellow travel book, as you mentioned, from my backpacking days, I mean, in advance of that trial, well, the top line data at least coming out, as you say, in April, May-ish next year, have you opened conversations with them about, this is a study that's ongoing, if XYZ top line results come out, are you amenable to it, or have they said, no, we're not going to go based on top line, you got to wait till, everything is done and dusted, upper phase 3 or whatever. Have you started discussions with them about how if it comes good in the top line, that you can get onto the commercialization phase as soon as the results are out?
Yeah, so I've started discussions with people that know how the CDC operate and how the Yellow Book's compiled. So they base that on peer-reviewed published papers, not based on approaches by companies lobbying to get their products into their book. So it's incumbent upon us, even with our phase 2 study that we've just completed. So we'll get the clinical study report at the end of this month, but we're working on a peer-reviewed paper being submitted and published next year. So hopefully in the first half next year, there'll be a peer-reviewed publication of our phase 2 results, and we'll need to do the same for that uniform university study as well. But if you look in the CDC Yellow Book at the moment, the only recommendations that they have for prevention of traveller's diarrhea are about hygiene. So drink clean water, wash your hands, be careful what you eat. They do, interestingly, mention bovine colostrum, but not by our brand name. And they have said that there's anecdotal evidence that it can assist in prevention of traveller's diarrhea, but not to the clinical standard that they require in order for it to be recommended as a preventative treatment. So they're already aware of it. Haven't mentioned us by brand name, but that is our product that they're talking about there. And so we need to increase that clinical evidence, and that could be that Uniform Services University study that I've just mentioned.
Yeah. Steve, we're bang on time there with that question, so we'll leave it there. Thanks very much for joining us, and hopefully we can get you back in FY25, maybe after the 4C in April, and hopefully you'll have the top line results to share with us, along with the sales from Travelan over the next couple of quarters.
Yeah, but I always welcome questions from shareholders or potential investors. So these are my personal email and mobile phone contact details. So do please feel to reach out to me. So ideas like the advertising in airport is not a trivial matter for us. It is something we take seriously and do consider. And any other ideas like that, welcome. Like there's no one has a monopoly on good ideas. So open to good ideas from anybody.
All right. Thanks, Steve. And thanks, everyone. Have a good rest of the Tuesday and indeed rest of the week. And we'll be in touch over email on a couple of other 4C events that'll be happening the back end of this month, early November. Okay. Thanks, Steve. Thanks, everyone.
Very good. Thanks, everybody.